Hi, this is Jim Cunningham with Christina Lindsay, and we're going to talk about qualified opportunity zones and oil and gas investing, a tax deferral and mitigation strategy. My goodness, that's a huge mouthful. But basically, here's the upshot. If you have had a capital gain, there is a strategy out there that we're going to discuss that some people do and some people don't do, right? But there's a strategy out there to defer your capital gain and also have a tax-free return of any appreciation beyond the investment. So super exciting. So this is for people who maybe sold something, realized a capital gain, whether it's short term, long term. There's a window of time when you can redeploy that money, not be taxed on it this year, be taxed on it later, and then the returns on top of your investment, those returns are completely tax free. So a great opportunity here. I'm Jim Cunningham. I'm a partner at Cunningham Legal. I've been an attorney for 30 years. We have offices throughout the state of California. I'm a certified specialist in estate planning, trust, and probate law. I'm a real estate broker, securities insurance license, and a pilot, single engine land. About 1,300 hours, mostly in a Cherokee 6, for those of you who are interested. These are the lawyers in our firm. We have a lot of lawyers dedicated to all things, frankly, for the mass affluent. These are people who care about growing and passing their wealth on to future generations while minimizing taxes and protecting from creditors. So we've got Christina Lindsay joining us, a principal at Ascent Wealth Management. She's a certified specialist in estate planning, trust, and probate law. And these are her other two partners, Shannon and Alyssa, on the screen. And Christina, I will let you read this disclosure before we get started.
Yep. And I'm just going to correct that I'm a certified accredited estate planner and a certified financial planner. I am not licensed to do law.
Okay.
I think you said estate planner. So I'm a planner. Yes.
A
But
certified financial planner. I'm sorry.
yes, no worries. And so any guarantees, this is certainly not an offer to buy or sell securities. There are no guarantees with most investments. So we just have to give that disclosure that we have to act as fiduciaries in most of these qualified opportunity zones and types of investments that would relate to oil and gas investing, unless you're investing in a big corporation and a publicly traded stock. It is going to be limited to accredited investors. And so this is not to be seen as advice for the webinar. It's informational purposes only.
Yeah, this is kind of like don't run with scissors, right? Do you want to give your disclosure?
I mean, very similarly, we have registered licenses with Cambridge Investment Research. Those are our FINRA licenses. We also have a registered investment advisory firm registered with the SEC. And this is certainly not an offer to buy or sell securities.
And here's the legal disclaimer before we get started. This is not legal advice. I'm a lawyer. When I say you, I don't mean that there's an attorney-client relationship attaching to this. Basically, don't watch this and go out and do a bunch of stuff without getting legal advice. So not going to be a whole lot of legal advice in here, but there is some tax counseling in here, or non-tax advice information that we would definitely want to make sure that, don't rely on this. And, sometimes people have a capital gain and we should probably talk about that before we get started. Sometimes people have a capital gain and they don't have capital gains tax. They might have a loss carry forward. So this is something you really want before you go and sell that thing, or maybe soon after selling it, at least meet with your tax advisor, find out, hey, I realize this capital gain. Is there going to be any tax? What will the tax be? Because if you don't have much income and there's not a lot of capital gain, there may be no tax, right? It may be zero federal tax. So very important to rely on your advisors to quantify what really the tax problem is. And then certainly if you're the kind of person who says, yeah, I already met with these people, I know I'm going to have this big tax bill, it drives me nuts. What are some things that I can do? And really, let's give a use case here, Christina. This might be somebody who sells a piece of real property and doesn't, their 1031 falls through, right? Their 1031 exchange. So they're left with, oh my gosh, I blew the 45-day term on identifying a property. I'm still within the 180 days, which is important, but I've blown that 45-day window in terms of identifying a property. These may be people who sell, maybe an investment that is sold, and you realize a capital gain, and you don't really have control on that, right? You might be an LP in an investment that says, hey, we're selling and we're cashing you out, and here's your money. And you go, great. What do I do to offset this capital gain? So maybe
Or sold a business.
Selling stocks, right? Maybe you have a short-term capital gain. Maybe you bought some NVIDIA at the beginning of the year and now you sell it and you go, wow, I have this short-term capital gain. So what are some things that you can do? What are some opportunities out there? or some strategies that really fall through the cracks of lawyers, financial advisors, and CPAs. So I will say that this is something that um, typically not one uh, industry or not one profession kind of has 100% coverage on, because it's a little bit of CPA. Is there a problem? You have to figure out what the problem is. On the financial advisory side, that you have your questions, and then on the legal side, there's a lot in there, and so really this does require this sort of team approach that we've talked about in other webinars of the attorney, CPA, and financial advisor, somebody like Christina, to make sure that this is appropriate for you. And with that, I will let you talk about opportunity zones, Christina.
Thanks, Jim. Yeah, it's very much a coordinated approach, and you should have a certified financial planner kind of acting as the quarterback, working with your CPA, working with your attorney. Is there tax loss harvesting that could be done? Is this an appropriate solution in general? And could it be a portion of many solutions? It could be a multi-pronged approach. So, an opportunity zone, this was first introduced in the Tax Cuts and Jobs Act of 2017. So really in 2018, when those tax laws went into effect, there were incentives for creating domestic jobs and employment, and going into areas that are typically either distressed or low income, and creating opportunity for employment and incentives, so that the tax incentives then passed along to investors that are investing within these qualified opportunity zones. So sometimes it's referred to as a QOZ, qualified opportunity zone. And there are many states that have adopted qualified opportunity zones as well. And they've all been approved by the federal Department of Treasury and recognized by the IRS. So this is straight out of the IRC tax code. This is not something that is unique or new as far as a structure for tax deferral. It is something that comes right out of the tax code. However, it is only for the 2018 to 2026 era. This will sunset when the Tax Cuts and Jobs Act does revert back to the old tax code. So unless there's a renewal or Congress passes new legislation, this opportunity to do a qualified opportunity zone will expire in 2026. So currently,
So if you're watching this, you might be thinking, gee, if this is going to expire in 2026, how does this all work? And what we're talking about here, a very unique aspect, is taking an opportunity zone. If you look at the map, kind of where Texas is and New Mexico, there's some large opportunity zones in there. So what we're going to talk about is combining oil and gas with opportunity zones. Now, Christina, we've covered this in other webinars, right? The oil and gas, correct? And we've walked people through that. So if you're not familiar with that, I would really encourage you to take a look at that. But a qualified opportunity zone defers the capital gains until December 31 of 2026. So again, you might be thinking, well, if I'm just deferring it till 2026, it's not that long. As we do this, we're in 2024. 2 years of deferral is better than no deferral, right? I mean, that's part of it. But there's another component. So please pay attention. Don't just say,
right. To add to that, Jim, so while it defers it until 12/31/2026, that would mean that estimated tax of whatever that deferred amount is due April 15th of 2027.
Right.
So to be clear, you can defer the capital gain. It has to be within 180 days. So if you sold a business April 1st, you have to have within 180 days, whatever capital gain exposure from that triggering event has to be placed into a qualified opportunity zone if you're going to take advantage of this strategy. And then the tax due on the amount deferred. So if you deferred $1 million and you've got 18.8% between the 15% federal capital gain and the 3.8% Affordable Care Act tax, you've got the net investment income tax, you've got 18.8% due April 15th of 2027.
Yeah, and so that's assuming a 15% capital gains tax rate. So the other thing to just think about, and this may be obvious, but it's not so obvious when you're doing tax planning, is sometimes it's advantageous to straddle tax years. Now, right now we're in the second half of 2024. So if you had your liquidity event within the second half of 2024, you could do part of it a qualified opportunity zone this year and part next year, you could also take some of that gain, some of the gain at a lower tax rate and defer out into future years. So it's kind of an income smoothing strategy. We've covered that in other webinars. And let's talk about the elimination of gains held for 10 years. What does that mean? So if I put, let's say, $1 million into this or 100,000, whatever the number is, the gain above that $1 million or that gain above the investment goes tax-free, right?
Correct. So to the extent that hypothetically, again, this is not a guaranteed strategy, and there's different types of investments that go with QOZs. Apologies. Then if you had a 2x, all of the gain, if that million became 2 million, comes out tax-free at the end of 10 years. It is tied up though for 10 years. There are some that along the way pay a dividend or an income stream or a distribution. So that's really where there are different types of QOZs where we'll walk through a couple scenarios, but you would get all of the gain completely coming out after 10 years tax-free. But there is a lockup period on the capital invested, along with the appreciation that's above and beyond any kind of a dividend or stated distribution. And that is locked up for 10 years. That's really why this is also not a strategy typically that is for maybe the entire gain. Maybe a portion of the gain is deferred, but people have to be able to afford the illiquidity on what they've deferred for 10 years.
Yeah. So the other, I would say the other problem with just broadly speaking of qualified opportunity zones, not only do you have this lack of liquidity, and your money's tied up. A lot of times these investments are real estate. They're like development deals. That's what I've seen, a lot of real estate. But what's really kind of cool about using oil and gas in an opportunity zone is oil and gas has an income stream. So the nature of the investment is you're getting your money back. You put money in, they pump oil out, you get your money back. And that tends to match up well, right, with the deferral through 2026 and then the future income above your investment. So we're going to cover that. But again, this is investing in a particular zip code or a particular geographic area in a business within that geographic area.
Correct. And those we're going to talk about oil and gas as a strategy because we're looking at two potential strategies here. Oil and gas also is just purely an income tax play, which again, we've done other webinars on, where you can mitigate current income tax through investing in oil and gas, which is part of the intangible drilling cost deduction that's been part of the tax code for about 100 years. And the depletion allowance. So we've talked about that in other webinars. So the strategy has been around for a very long time. Drilling in our domestic reserves has been around for an incredibly long time. But qualified opportunity zones also could be, drilling could be a part of those qualified opportunity zones. A lot of what we saw in the early Tax Cuts and Jobs era when these qualified opportunity zones first came out was real estate. Now, real estate typically is levered. Typically, it could be subject to debt refinancing, debt restructuring, and this uncertain interest rate environment could pose additional risks. So what we're talking about is a qualified opportunity zone that includes the QOZ investment, the underlying investment strategy being drilling. And so that's kind of what we're focusing on today is just this is something that's not levered typically. And is just a traditional drilling income strategy, but with a QOZ wrapper around it.
Yeah, I mean, if oil is the chocolate in this example, the QOZ is the peanut butter, right? And you put the two together and you got something that's really good, right? For not everyone, right? But in certain circumstances and for, certain levels of investment, whatever it is. But this is really important just to get your head around this on a high level is what we're doing is we're looking at the qualified opportunity zone and then aligning it with an investment that is structured to return a stream of income essentially to cover the taxes that are due when this expires, when the tax deferral expires in 2026, right? So
Right.
when that tax is paid in 2027, I will say that if, you're paying quarterly taxes that could, to get your safe harbor, you might have to pay some estimated taxes in there in 2025 or 2026 as well. So a little bit of a nuance there, but All right. Well, let's talk about the overlap of opportunity zones and oil. What are we talking about here? What are we looking at if you're looking at this on video?
Yeah, so these are all the major oil and gas basins in the United States, and then kind of overlapping those that they do overlap some QOZs. And the one that we typically work with the most is the Permian Basin in Texas and New Mexico. That's going to include, Midland, Odessa, Carlsbad, Hobbs, New Mexico, and then some components of Oklahoma. But that's really where you have an overlap of, proven reserves that are all old salt beds, and they're areas that have also done fracking in an environmentally friendly way that don't contaminate any kind of a potable water bed because it's all old salt beds. They do desalination, and they do water reclamation from a lot of the drilling activities. They've had regulations of how to deal with this in an environmentally friendly way for 100+ years because they're proven reserve areas. Whereas dealing in more new drilling areas that maybe the Appalachian, there's areas that they've had environmental concerns. They didn't have regulations to deal with these things where they did in the Permian Basin. So that's typically we're working with, at least in our firm, with companies that have proven track records, that have proven reserve, they're working with proven reserve areas that are environmentally friendly as well. So that's really where we're looking at opportunities to wrap the drilling reserves and areas that have done this for a long proven track record, as well as are also in a QOZ to provide additional tax benefits to the clients.
Yeah, maybe as you were saying this, they're proven oil reserves. What does that mean? That means that all the smart kids know where the oil is. They know how much oil is there. The question is, how much does it cost to get the oil out of the ground? Really, that's the basic question. So if the price of oil is lower than the cost of extraction, so if it costs you $60 a barrel to take oil out of the ground and oil's trading at $50 a barrel, you cap the well, right? You don't
Well,
you wait. You
and
wait for it to go back
truly,
up, right?
truly with the technology and geological engineering reports and everything, and all the advancements that they've made with technology and AI and everything else these days, what they're able to do is pretty impressive because if you're going into multiple layers of shale, you're going into proven reserves to the extent that overwhelmingly that basin in those areas, most of the companies haven't drilled a dry hole since 2009. It's just not something that is very common unless you're wildcatting and trying to find oil. But if you're going into proven reserves, you're going into deeper levels of shale of proven areas. And if you know it's there and it's then a quarter, 50 yards just away from that particular drilling location, rather than having the cost and expense of Halliburton or the operator, taking the entire rig down and the cost of then having to open another rig, they can take that rig and walk it 50 yards and set up camp to do the next drilling site. So the cost reduction in oil and gas drilling has also been pretty expansive.
And the US is the largest oil producer. A lot of people don't know that.
Mhm.
We still import oil, not a lot, but we still import it.
Mhm.
Well, let's talk about prices. Where are prices going? Where's oil going?
Yeah, I mean, it's always hard to say where is the price going. And from what we've seen, with this particular Middle East conflict, we haven't seen a whole lot of conflict that impact oil pricing for where the location of the Middle East conflict is. What we really saw was a huge spike right after COVID, just because producers stopped producing as much. And that's a scenario where they would cap the wells, when during the COVID lockdowns and you had just negative oil prices and less demand. But we've exceeded the pre-pandemic, even with electric vehicle usage and everything else, we're above pre-pandemic usage significantly. So demand is strong. I think that we're probably, it's always hard to predict where the puck is going, but if I had to say what most of these major institutions are predicting is a range bound oil situation where we're probably going to be range bound between 75 and 95 for a foreseeable period of time. So it's we're not dealing with $120 per barrel prices. We're not dealing with below 50. We're pretty much in this range bound scenario. And that just shows, rig count. As you can see, rig count came down significantly during COVID. And the rig count, while demand for oil is above pre-pandemic levels, our rig count is not back up there yet domestically. So we're increasing, but we're certainly not to full capacity of production level.
Yeah, right now the graph's showing 500 rigs in the whole United States.
Mm-hmm.
You think there'd be more? I don't know.
Mm-hmm. And natural gas is pretty steady. Mm-hmm. And so I think that that's another thing too, as far as exporting natural gas, it's going to pretty well stay domestic. So natural gas is probably a small component of most of the revenue source for QOZs and drilling programs. It's mostly oil based.
Yeah, and oil, by the way, people say, oh, well, depending on who's in the White House or who controls Congress, is government going to curtail or throttle back the tax advantages for oil and gas? And I think the answer is no. This is not a Republican or a Democrat issue. This is a policy that the United States has been following for 100 years. I don't see them deviating from that. We need to produce energy. It's just
Sure. I mean, there's always the unknown. We could
true.
certainly we could see that, but the one thing too is with the Permian Basin being that you've got New Mexico fairly purple blue, and you've got Texas red, and in those areas you've got both states where New Mexico, that's one of their largest revenue sources and tax revenue sources, and so a lot of the people that have been in politics and in legislative they've been also in the Obama administration, also in the Biden administration. So a lot of the energy executives, if you will, have a pretty strong voice with both administrations and have navigated both administrations just fine.
Yeah.
And this is just, I think that we can all understand that even though EV has been a mandate or trying to be a mandate in certain areas, it's just not going to work in every aspect. And so there's not enough power to support it. You have weather conditions. And so I think that that's really where the hybrids might, gain some traction. But ultimately, even as we've increased to close to 5% adoption rate, we're still nowhere near the adoption rate, and we're hitting a plateau. You're actually seeing declines in EV sales just because they've kind of hit that market adoption. And you're never going to get rid of the demand for oil. They're not flying electric planes anytime soon.
Yeah, and also AI uses a lot of energy. I just saw an article. I
Yes.
think it was like Silicon Valley Power. It's like 60% of the power was went to servers that are running AI.
And
And,
oil and the crypto mining takes
right.
even more.
I read that an AI search requires like 30 times the amount of electricity that a Google search requires. So that AI is not going away. That's coming on pretty strong. So definitely demand for power. A lot of the
Yeah.
power does still come from fossil fuel. And to your point is, solar and wind, unless you're storing it in some type of mechanism.
Battery.
Although I did see there's a proposal to build, I think it was in New York City, a massive tower with big blocks that they would kind of haul up during the evening when there's or day with solar, and then they would come down as power was needed or something. But
Hmm.
who knows? It's a big gravity battery, I guess.
Who knows? Yeah. So this is just showing, and this particular slide was just showing one of the producer companies that we work with, but this just shows some of the private producers that are out there. Newborn Oil is one of the companies we work with. Or not making any recommendation to purchase a product with them in any way, shape, or form, but a lot of these private producers end up selling to the end users. So one of the things that we've seen is as you have some of the ESG mandates of corporate publicly traded companies, as they have done less of the drilling necessarily themselves, but they're still purchasing it as the end user. So they're buying it from a lot of these private operator companies. Mewborn is an example of one of them. There's a couple other companies, US Energy, others that work in the Permian Basin that are privately held that sell to the big companies so that they can meet all of their corporate mandates on the
Yeah, and it's also capital intensive too. So it takes a lot of capital to drill a well. And I think sometimes these corporations maybe can't use all the tax benefit. I don't know, or maybe it just doesn't even make sense. It makes more sense to use that capital doing something else, maybe in distribution of energy versus the actual drilling. So that's why you see a lot of non-big names, not the Exxons and the Chevrons doing the drilling. It's these the smaller players. So maybe talk about environmental considerations on oil and gas. I know some people are concerned about the physical act of extraction as well as the when this stuff is burned ultimately.
Yeah, I mean, I think that obviously having multiple different sources of energy and more green, efficient sources are important. But there's a balance, and at least there is an environmentally friendly way to do the drilling for the oil and gas demand that we will continue to have. And one of the things that was impressive to me when I went out to some of the on-sites in the Permian Basin was looking at the drilling rigs and the tubes that they use to drill might be like this 12-inch diameter initially, this huge metal tube that's going, thousands of feet down in the earth. And then when they drill that initial hole and they know that they've tapped the resources that they need to, they then create like another, let's call it like a 4-inch hole. And then everything between that, the original metal wall and the 4-inch hole gets quick dry cement. And it's just this huge cement barrier wall. And then there's another layer of protection. And then the actual hole that they're drilling through might only be like 2 inches in diameter. And don't quote me on the exact inches here, but I'm trying to give the visual, and how they were describing it to me is that there's these layers of cement protection so that it would have to go through 2 metal and cement barriers to have any kind of contamination of where they're drilling. And where they're drilling in these areas like the Permian Basin are areas that are old salt beds. And so they're not contaminating, there's no potable water there. And a lot of these people that this is the largest employment source for those areas. And so if you've got people living with their kids, going to school, living in these communities, they're very cautious of making sure that they're not contaminating the resources that they live in, So I think that that's one thing. And then desal, every time that you pull oil out of the ground, you're pulling, oil, natural gas, salt water, sand. And a lot of times what used to take place in the old days is you would take that salt water or sand and just go find a dumping, site that would be still safe. Now they're taking that salt water and taking it to desal plants to do water reclamation and those kinds of things. And so it's become even more environmentally friendly over the years, and there's no high volume flaring or those kinds of things allowed. So it's come a long way, especially in an area like Texas that's been drilling for, centuries. So where it's the areas where you see the I forget the Mount Damon movie that came out a long time ago and that was contaminating and they were dumping. Those are all in like the Pennsylvania and Appalachian shale areas that they had no regulation. They didn't know what to do with it, and they didn't properly prepare for allowing those things to take place. And so it isn't something that's a common practice in areas that have the regulation, do it properly, and have been doing it properly for a long time.
So let me ask you, even if you don't have a capital gain, let's say you're just doing straight oil and gas investing, does it make sense to do this or not?
And so this is really where it could be a combination of the two things. And so we have worked with a lot of clients that have had capital gain exposure where we've done both. We've done drilling programs for income tax deduction. But if you've got a capital gain taxed differently, it could be advantageous to defer. So I think we've got a couple examples of how that could work.
I don't think we do.
No?
Nope.
Okay.
So that's why I'm asking.
Okay.
I'm looking at the slides that are coming up. I don't see them.
Okay. Well, let's see. What else do we got? And then I can kind of give an example.
That's about it. We're at the end.
We're at the end. So if we go back to the deferral, like timeline, if you defer within 180 days, for example, I'm just going to use some round numbers. If you had $1 million of deferred gain, most qualified opportunity zones, and I'm just saying most, again, we'd have to quantify the specifics of a particular program. Most qualified opportunity zones will have some accumulated dividends or income generated from the underlying investment, whether that be oil and gas, whether that be, rents from a real estate transaction. But most of the QOZs have some form of an income generating component. And that will then typically be held by the operator or manager of that QOZ. And then oftentimes they're projected to have enough capital to pay that deferred capital gain of 23.8, assuming someone's in a 20% federal tax bracket for capital gain rates. And then you have the 3.8 net investment income tax. So you've got 23.8. So most companies will be in a position to distribute that 23.8 by April 15th of 2027 when that tax comes due. And so the intent is that looking for a qualified opportunity zone that does have the ability to then pay you through distributions what that tax would be. That's important, looking at the underlying investment. And then looking at once that tax comes due, keep in mind that that's federal. A QOZ does not avoid state income tax. So for those in California, you'd be able to defer the 23.8 and at least reduce your tax exposure on your federal return, but not state. Now, then for whatever is in that, so let's just say you've deferred that $1 million, you've then gotten a distribution to cover your federal tax due in April 2027. Then along the way, while you own this investment, there typically is going to be some form of a distribution that could be coming from the oil and gas royalty income. And as they're drilling, they're distributing some of that along the way. But then they're probably keeping some of that protected, if you will, from taxes, because anything that's distributed is taxed as ordinary income. So you might want some income, but you might not want so much that it's then, all taxable to you. And if that $1 million plus whatever is accumulating through distributions comes out at $2 million in 10 years, and again, this is not a guarantee, I'm just using a hypothetical, but a lot of these are hypothetically geared for growth and capital appreciation. At the end of that 10 years, all that gain comes out tax-free.
Yeah. So unlike a normal oil and gas investment where you put your money in and it's almost like you're getting a more money earlier on, and then it kind of tapers off maybe over a 15-year period. The way this is structured in order to get the tax-free benefit of a qualified opportunity zone, you're not going to get any money beyond like the taxes. This thing's locked up for 10 years. So this is a 10-year hold. So this is not something, if you say, gee, I need this money in the next 10 years, but that may not be for you, right? I mean, if someone's looking at this, but if somebody says, look, I'm just really annoyed I have to pay the tax, and this is something that I can have sit for 10 years, and that comes back tax-free, right? Then this is maybe something to look at. And again, I think that's why you said at the beginning, Christina, this is not like, of all the capital gain, you're going to put all of it in there, because 10 years is a really long time, right? A lot can happen in 10 years. So the idea here is that it's in oil and gas, which has a track record of 100 years of, it's a business that's been around a long time. And this, frankly, is why real estate kind of works, because obviously real estate's been around a long time. So this is why I think that you see a lot of real estate investments in QOZ. But understand, if you're looking at this is a 10-year lockup. This is a very long time. I mean, what other investments are a 10-year lockup?
Not many. I mean, some real estate. I mean, a lot of times people think, well, real estate, I can touch it, I can feel it, I can control it, but is it really liquid? You have to have a buyer. So it may not be liquid, but you can count on a specific, set of rents, assuming that the tenants pay. So, I mean, similarly with most QOZs, whether it be real estate or whether it be oil and gas, there's going to be some sort of a predictable pro forma of what you could expect as a distribution along the way. That being said, you know, it's money that you have to be able to lock up. So this is a multi-pronged approach that, you know, if we are dealing with clients that have sold their business or sold, like you said, sold an investment or sold a stock, that we can't harvest losses, that we can't do carry forwards on, we may look at doing this with a combination of 3 or 4 other strategies. And so this is really where working in coordination with your A team is important.
Yeah, I mean it's no different than saying like, hey, I'm gonna have a dinner, right? I'm gonna invite some friends over for dinner. You're not just gonna serve them all, you know, steamed carrots or something. You're gonna have a little bit because you want to make this be a plan. You want to make it something beyond just a. This is not a one size fits all. A single a some type of single strategy that's going to cure everything. This is part of a multi-layered, multi-year approach. And again, having this structure of the 3 advisors, the attorney, the financial advisor, and the CPA, the certified financial planner, that really does make sense because this requires, if it's a 10-year investment, it frankly implies that there's a plan of maybe more than 10 years, right? 15 years. This comes up a lot with clients who look at Roth conversion strategies. So,
well, and with the QOZs, they have to liquidate in 10 years.
Right.
Per the QOZ rules in the IRC tax code. So they have to fully liquidate in 10 years and close.
Well, that brings us to the end of our time together. So if you're watching this on YouTube, please subscribe to our YouTube channel. This was a great time that we spent to learn about qualified opportunity zones and oil and gas. And our firm has office locations in Northern and Southern California. This is our contact information for Ascent Wealth Management. And I don't know why we have so many numbers. You can call any one of those and it rings to us. And next week, if you're watching this live, we haven't done this yet, but if you're watching this on YouTube, it might already be out on YouTube. The professional trustee, the independent trustee, what is it and should you have one? So sometimes trusts must have an independent trustee for tax reasons, but we're going to have Premier Trust. Aaron Kennedy is joining us, and we're going to talk about independent trustees. And we'll also talk about the whole concept of maybe not one of your friends or family serving as trustee, but maybe a third party. And so we'll get that perspective. I'm very excited about that. And again, if you're watching this on YouTube, please subscribe to our YouTube channel. And
I was wondering if you can go back to that slide for a second.
Yeah.
I was wondering why our, no, sorry, go forward after the YouTube channel. There we go. I was wondering why our other phone numbers weren't showing.
Yeah.
Like we have our, for whatever reason, that other slide was just showing, we had 2 contact information slides in our.
Well, there it is.
There it is. There's our other numbers.
So we will open it up for questions. If you're watching this on YouTube, go ahead and keep watching because another video will magically appear. But if you're watching this live, we're going to answer your questions.